Welcome to the deep dive. Today we're taking a huge stack of forensic analysis on a semiconductor giant, and we're going to boil it down to the insights that you really need to understand.
And that giant is Micron Technology, ticker MU.
Our mission today is a full deep dive on Micron. This company is really the poster child for cyclical volatility. It's the classic boom and bust stock.
It absolutely is. And that's what makes this so critical right now. The stock is trading near its all-time highs. We're looking at a price of around, what, $236.88?
And the fear is palpable. You can hear everyone on the street screaming, "Peak earnings, get out now!"
But that's the hook, isn't it? The forensic report we're breaking down today makes the exact opposite case.
A pretty bold case. It argues that this isn't the peak of a cycle at all. It's the start of a multi-year supercycle.
Right, one driven by AI demand and, surprisingly, by the fundamental laws of physics.
So the core challenge for us, and for you listening, is to figure out if that old historical pattern has finally been broken.
Exactly, that mechanism that always crushed memory prices. You know, the supply response, where high profits lead to this immediate, overwhelming flood of new production.
Is that cycle well and truly broken? Because if it is, all the old rules for investing in a company like Micron, they just don't apply anymore.
Okay, but before we get into this thesis, which the report calls a fat pitch opportunity.
We have to cover the ground rules. All the analysis you're about to hear is based on publicly available sources. It could be subject to revisions or different interpretations.
And of course, this is all for educational purposes only. It's not investment advice. You absolutely have to do your own due diligence before making any decisions.
All right, let's unpack this. The report's central idea is that Micron is changing.
Yeah.
Transforming from just a supplier of dumb bits.
You know, basic interchangeable memory chips.
Into something more like a specialized utility provider.
Yeah.
So what's driving this massive cycle-breaking change?
It's the perfect storm, really. A collision of two huge independent forces. First, you have this massive secular demand shock from artificial intelligence.
The LLMs, the data centers, all of it.
All of it. And second, you have a structural supply problem. We're calling it the complexity wall. And it's where Moore's law is basically hitting its physical limits, specifically for memory manufacturing.
Okay, let's stick with the physics for a second. The report says the key to this whole thesis is high bandwidth memory, or HBM. Why is HBM so important?
HBM is designed to solve the single biggest bottleneck in AI processing. The memory wall.
The memory wall.
Yeah, think about it this way. You have an incredibly powerful AI accelerator, like NVIDIA's Blackwell GPU. It can do quadrillions of calculations a second.
Just a staggering number.
But if the memory can't feed data to that chip fast enough, the processor just sits there, idle. It's waiting for the bits to arrive. HBM solves that problem.
So how's it different? I mean, how's its architecture different from the standard DRAM chips we're all used to?
Standard DRAM is flat. It's laid out on a circuit board with these long, slow connections. HBM just completely flips that on its head. It stacks the DRAM dies vertically, like a skyscraper of chips, maybe 8 or even 12 dies high. And they're connected by thousands of microscopic channels drilled right through the silicon itself. They're called through-silicon vias, or TSVs.
That sounds incredibly difficult to manufacture, not to mention risky.
And that is the absolute core of the thesis. It's exponentially harder. Imagine drilling thousands of perfectly aligned microscopic holes through a stack of what is essentially fragile glass.
One mistake and the whole thing is useless.
Exactly. If one channel is off, if the wafer cracks, if the thermal bonding isn't perfect, the entire very expensive chip fails. The report says this process, quote, decimates yields.
So a huge percentage of what they make is just scrap.
A huge percentage. HBM is fundamentally an engineering marvel that's a nightmare to manufacture at scale.
And that difficulty, that's what creates the scarcity dynamic, right? This cannibalization effect. Walk me through the economics of that.
It puts a hard ceiling on supply. Because the process is so complex and the yield loss is so high, the analysis shows that for every one wafer Micron uses for HBM.
The really high margin stuff.
Right. For every one of those, they remove about 3 wafers worth of standard DRAM capacity from the global market. You just can't physically flood the market with both at the same time anymore.
Hold on, I have to push back on that. If HBM margins are that high, why not just build more fabs? Isn't that the old supply response we were just talking about?
That's the perfect question, and it's what the market is missing. The complexity wall we're talking about is happening right now. Building a new $20 billion fab takes 4 years, minimum.
So until that new capacity comes online, way down the road.
HBM production has to steal from standard DRAM supply, and that's what breaks the historical overproduction cycle.
Which means the unit economics for Micron are totally different. The old gross margin ceiling has to be gone.
It is. Memory gross margins were always trapped, in that 30 to 40% range. It was a commodity. If prices went up, competitors would just flood the market.
But not anymore.
Not with HBM. It commands a 5 to 7 times price premium over standard DRAM. And that is pushing Micron's gross margins up towards 60%.
60%?
Uh-huh.
That's a logic designer number, like NVIDIA, not a manufacturer.
It's completely transformational.
Okay, this is where it gets really good. Let's move from the physics to the financials. If this scarcity is real, then the Q1 fiscal 2026 earnings call from last December, it should show some hard evidence. What signals did we get from management?
The language was, it was a complete shift. They went from being cautiously optimistic in prior quarters to just confirming physical scarcity. The phrase they used over and over was supply constrained.
Meaning the problem isn't finding buyers, it's making enough product.
They're selling absolutely everything they can possibly make.
But the single most important data point, the one that really confirms the multi-year thesis,
was that they had completed agreements on price and volume for our entire calendar 2026 HBM supply.
sold out.
Completely sold out. Locked in on price and volume for the next 2 calendar years on their most profitable product. That de-risks their revenue in a way we've just never seen in this industry.
But wait, sold out for 2 years. Sounds almost too good to be true. Are these contracts firm? What's the catch?
That's the right skeptical question to ask. And while there are always clauses, management used the term agreements and specifically quantified the full supply. The commitment is exceptionally strong.
And there was more, wasn't there?
Yes. Management even expressed disappointment that they were, quote, unable to meet demand from other customers. They are actively turning away business. The bottleneck isn't sales, it's manufacturing. That's the very definition of pricing power.
And we see that scarcity in the numbers. Q1 revenue, $13.6 billion, but the guidance for Q2 fiscal 26.
It shot up to $18.7 billion, give or take $400 million. That kind of sequential growth is, well, it's basically unheard of for a company of this size and maturity.
Okay, but we have to be sure this growth isn't just accounting tricks. The forensic report applies a shenanigans test, looking at working capital.
Right. You're looking for red flags, channel stuffing, inventory bloat, anything like that.
So let's look at the holy grail metric for a memory company. Inventory velocity. That's measured by days inventory outstanding, or DIO. Why is that the crucial one?
Because for a memory company, inventory is a melting ice cube. It's their biggest risk. When prices crash, all those chips in the warehouse are suddenly worth a lot less.
Leading to huge write-downs.
Exactly. Back in the 2023 bust, DIO spiked to 182 days, a huge rotting pile of inventory. Today, it's fallen way down into the 126 to 140-day range.
And this is happening while revenue is skyrocketing.
Which is the key point. The inventory is literally flying out the door. It completely confirms the shortage that management is talking about.
And the other side of that coin, days sales outstanding, DSO. Any sign of them forcing sales by giving customers easy payment terms?
Nope. DSO is stable right around 57 days. The receivables are growing right in line with revenue. There's just no evidence of channel stuffing. The financials back up the story perfectly.
All right, let's shift gears to the structural moat. What stops the other two members of the big three, Samsung and SK Hynix, from just building more capacity and killing this supercycle?
Well, the barriers to entry are just becoming insane. To build a modern fab with the latest EUV equipment, you're looking at $15 to $20 billion.
And it's just for one.
For one. And then it takes 3 to 4 years minimum just to build it and install the tools. You can't just react to high prices anymore. Plus, there's a global shortage of the specialized cleanroom construction crews you need.
But we have to talk about the anti-moat, the China threat. Companies like CXMT and YMTC are building a ton of capacity for older legacy DRAM.
And that's the strategic imperative for Micron. They have to get out of that market. They have to abandon the low-end commodity game to survive.
So this whole shift to high-end HBM isn't just a growth play.
It's a survival strategy. It's about avoiding the red ocean of commoditized chips, where they'll inevitably get crushed by state-subsidized Chinese competition.
Okay, let's tackle the biggest fear hanging over this stock, CapEx. Capital expenditure. Micron guided to around $20 billion for fiscal 26. Historically, that's the signal for the top of the cycle.
And that fear is totally rational based on decades of history. But the forensic analysis shows a structural inversion of that cycle. We're seeing rising capital intensity.
Can you define that in this context? Rising capital intensity.
It means the industry is spending more and more money to get fewer incremental bits of memory.
More money for less growth.
Think of it like a Formula One engine versus a regular car engine. The F1 engine costs 10 times more to build, but it only produces a little more power because the engineering is so extreme. Micron is spending $20 billion not to flood the market, but just to keep up, just to get modest bit growth, because HBM is so complex.
So that huge CapEx number is actually defensive spending, not offensive. The supply response is dampened because the tech is just too hard to scale cheaply.
Exactly. It breaks the old historical signal and it supports the scarcity thesis.
Okay, so let's bring this all together. As Charlie Munger would say, invert, always invert. If this supercycle thesis is so strong, how does it fail? What's the pre-mortem?
There are three big risks. The number one risk is an AI winter. The entire bull case depends on this insatiable demand for AI. If LLMs hit a scaling wall, or if the hyperscalers—
Google, Amazon, Meta, Microsoft.
Right. If they fail to monetize their huge AI spending, they will slam on the brakes.
And memory is at the very end of that supply chain whip. A small cut in hyperscaler spending turns into a massive price crash for Micron.
Absolutely. If AI spending growth slows from 50% to 20%, memory prices don't just flatten out, they could collapse by 50%.
What's the second big risk?
Technological displacement. New tech like Compute Express Link or CXL is all about efficiency. It lets servers pool and share memory. If you get more efficient, you just don't need to buy as many physical bits. Efficiency is the enemy of volume.
And the third risk loops back to that massive CapEx number. It could become balance sheet suicide.
It's a huge bet. If Micron commits to $20 billion a year through 2028, and the cycle turns hard in 2027.
Say, because of that AI winter.
They'll be caught with brand new, very expensive fabs coming online just as demand disappears. That leads to catastrophic cash burn and probably shareholder dilution.
We should stress, though, that they do have a defense. Management has shown a very Klarman-esque trait, a focus on having a net cash position. They entered the 2023 bust with net cash, prioritizing survival.
That's a huge defense. And don't forget the hidden asset, the $6.1 billion CHGPS Act grant from the government. That's basically non-dilutive equity that lowers their future spending needs.
Okay, let's wrap this up with valuation. How do you even value a company this volatile? It swung from almost $12 of EPS in 2018 to a $5 loss in 2023. The report uses three different methods.
Right, you have to. We start with the historical view, what the report calls a Buffett-style normalized mid-cycle valuation. This assumes the past will repeat itself.
And how do you get that normalized EPS?
You average the boom and bust cycles. You take an estimated peak revenue of around $53 billion and the bust revenue of $15 billion. That gives you a normalized EPS of about $8.90.
Then apply a standard multiple.
A 15x multiple on that gives you a valuation of $133.50, which means at today's price of $236, the stock is massively overvalued if you believe the old cycle will just repeat.
So the whole thesis rests on rejecting that valuation. If the structure has really changed, we have to look forward. What does the super cycle forward PE model say?
This model accepts the new reality of scarcity and high margins. It's based on the fiscal year 2026 EPS estimate of roughly $16.
$16. And you'd apply the same 15x multiple.
You would, because the quality of earnings from HBM is so much higher and more predictable than the old commodity earnings.
Okay, so $16 times 15. That gives a target price of $240.
Which is surprisingly close to where it's trading now. It suggests the stock is actually fairly valued based on near-term fundamentals, assuming this supercycle is real. The fair value zone is probably $240 to $260.
And what's the bull case?
If the supercycle extends through fiscal 2027 and EPS hits, say, $18, then the target could reach $324. The alpha opportunity isn't buying a cheap stock anymore. The alpha is in the duration of this cycle.
So the recommendation here isn't to chase it, but to accumulate on pullbacks.
Absolutely. You're looking for pullbacks to that $210 level with the goal of riding out this scarcity that we're seeing, confirmed by those sold-out contracts.
And that brings us to our final thought for you to take away. Micron's entire investment case really boils down to one question. Have AI and HBM created a permanent structural scarcity that finally breaks the old supply cycles?
All the evidence we've seen, the gross margin expansion, the language from management, the inventory velocity, it all points to yes, the supercycle appears to be real.
So here's the long-term implication to consider. Because of this complexity wall, the entire memory industry now has to spend dramatically more capital to produce less growth.
So will this permanently transform these companies into high-margin, low-volume specialists? Will they be forced to completely abandon the old commoditized markets? That would be a fundamental business model shift, unlike anything we've seen in decades.
A phenomenal pivot point for the entire industry. Thank you for joining us for this deep dive into Micron technology.
And remember, all this analysis is based on publicly available sources and is for educational purposes only. It doesn't constitute investment advice, so please conduct your own due diligence. If you want to access more advanced content or listen to our full deep dives, you can join our Deep Value Club membership or subscribe on Apple and Spotify podcasts at the channel. Deep Value Investing. Thank you.